Welcome to the Intelligent Investing Podcast, where modern portfolio theory can suck it. A student of the school of Graham and Doddsville and a clergy member of the Church of Warren Buffett. Here's your host, Eric Schleien.
Good morning, guys. This is the Intelligent Investor coming at you on Saturday, February 23rd, the morning of the Berkshire Hathaway letter for 2018. So I wanted to get right into it. Woke up nice and early, like I'm sure a lot of you did. So I wanted to go a few things. I took some notes and just wanted to make a quick podcast to go over my notes, and would love, anyone who wants to email me or send me a message on LinkedIn with, your feedback or anything you think I missed or anything you just think I'm super wrong about. Please feel free to message me. All right, so we'll get right into it. So the first thing was, I'm just looking at my notes here. I'm not going to just read through the entire letter because you don't need a podcast for that. You can just do that on your own time. The first thing was, on the first page, Buffett talks about focusing on operating earnings and paying little attention to gains or losses of any variety in investments. And that's simply because of the new accounting principles where he says, wide swings in our quarterly GAAP earnings will inevitably continue. That's because our huge equity portfolio, valued at nearly $173 billion at the end of 2018, will often experience one-day price fluctuations of $2 billion or more, all of which this new rule must be dropped immediately to our bottom line. Indeed, in the fourth quarter, a period of high volatility in stock prices, we experienced several days with a profit or loss of more than $4 billion. So he's basically just saying that these new accounting rules are, he's reiterating it's totally ridiculous. I agree. I think it's completely inappropriate, just from an accounting standpoint, to have price fluctuations of common stock to be getting dropped to the income statement. That just makes absolutely no sense. That just should be a balance sheet issue, and leave it at that. But it is what it is. So he says ignore that, but he also says, obviously it's important what our investments do over the long term, so not to dismiss investments, and that they should be calculated as part of intrinsic value. I think most of you get that. So also on the first page, this is a big deal, and I think it's a long time coming, quite frankly. He says, longtime readers of our annual reports will have spotted the different ways in which I have opened this letter. For nearly 3 decades, the initial paragraph featured the percentage change in Berkshire's per share book value. It's now time to abandon that practice. And, what he's really saying here is, while book value is still somewhat of a yardstick for business performance, it's getting significantly less material to intrinsic value every year. And he makes a note, a few reasons basically why he's getting rid of that. So he says, there's 3. He goes, the fact is that the annual change in Berkshire's book value, which makes its farewell appearance on page 2, is a metric that has lost the relevance it once had. I think most of us Berkshire followers know that. So he says 3 circumstances have made that so. The first is that Berkshire has gradually morphed from a company whose assets are concentrated in marketable stocks into one whose major value resides in operating businesses. So when you're trying to value Berkshire Hathaway and you're looking at their operating businesses, you're not going to be valuing those operating businesses for what they're on the balance sheet. And simply because, as a lot of these operating businesses continue to grow, they don't get marked up on the balance sheet. So they're still there for the original cost, which is really silly, especially with a company like Geico, for instance. It's clearly going to be worth more than what they paid for it. So that's the first thing, is you're going to be valuing the operating businesses, at some kind of multiple to pre-tax earnings, or post-tax earnings, whatever you want to do. But it's going to be a multiple of earnings, not what the book value is of those operating businesses, right? I mean, if you owned Apple in its entirety, you wouldn't be valuing Apple computers based off its balance sheet. You'd be valuing Apple based off its earnings. Okay, I think that's simple. The second thing is, he says, while our equity holdings are valued at market prices, accounting rules require a collection of operating companies to be included in book value at an amount far below their current value, a mismark that has grown in recent years. So I just said that. And then third, and I think this is important too, I've discussed this with some of my friends, but I'm glad that Buffett's saying it, because it actually was interesting that the new buyback policy essentially would decrease book value over time, while if Buffett and Munger were right in their analysis of their own stock, you would essentially be decreasing book value, right? Because you're buying, say, every time they buy back Berkshire shares, unless Berkshire goes below book value, then that's a whole different ball game. But as long as they're buying back stock at, say, 1.3 times book, 1.4 times book, 1.5 times book, whatever the multiple was, every time they buy back stock and they're paying a premium to book value, you're decreasing the book value per share of Berkshire Hathaway. Yet, if the intrinsic value ends up being significantly higher than what they're paying for their own stock, now you have a situation where intrinsic value is going up while buying back stock above book value, so therefore book value is going down. So the yardstick of increases in book value, the more that they bought back stock, which inherently should increase intrinsic value, the more their book value would decline. So there's a real mismatch there, and that's the third point he makes, and where he says, Berkshire will be a significant repurchaser of its shares, and over time, he says, and transactions that will take place at prices above book value, but below our estimate of intrinsic value. The math of such purchases is simple. Each transaction makes per share intrinsic value go up, while per share book value goes down, and this combination causes the book value scorecard to become increasingly out of touch with economic reality. So I think that makes a lot of sense, and I'm just glad he said it. So you can hear me ruffling through the pages. I printed this out this morning, and all my notes are handwritten, so bear with me. He also says that going forward, instead of using the book value per share change to calculate intrinsic value, going forward, he's going to measure business performance with Berkshire's stock price. And, what he's saying is basically quote, markets can be, he goes, we expect to focus on Berkshire's market price. And, he basically says that, day-to-day movements may be noise, essentially. I'm just paraphrasing him. But he says over time, Berkshire's stock price will provide the best measure of business performance, which, I would agree with. Is over time, the stock price does inflect intrinsic value of a company. He talks a little bit about Ajit and Greg Abel. So Ajit Jain and Greg Abel, some of you may know this, a few years ago, he made them both vice chairman of the company. So there's lots of speculation that either they're going to have some kind of dual role, or one of them is going to end up replacing Buffett after he dies, or they remove the keys from him, so to speak, if he gets dementia or something. So they, he talks about them, and he says that they both have rare talents, and that since he's put them in charge of management, with Ajit managing the insurance operations and Greg managing the non-insurance subsidiaries, that these companies are now better managed through the oversight of them than it was over at Buffett. And I thought that was very interesting. Obviously, they're still very much a decentralized structure, so they're not probably doing a lot of managing, but clearly there's some value add in the managers, reporting back to them and them being in whatever dialogue they're in. Now, Buffett, this is probably my favorite part of the letter, just because this is where a lot of the value community sometimes has had disagreement with me. I feel like I've been in the minority on this one. and it's okay. I don't think that necessarily one is better than the other. This is the way that my mind works. So basically, Buffett is saying that we need to focus on the forest and forget the trees. So he's saying when you want to value Berkshire Hathaway, stop getting into the minutia, stop looking at every single little subsidiary, and just look at the general parts of the company that create value, and don't go into every little detail. Now, that is something that I've been doing for the life of me valuing Berkshire Hathaway, and I approach stock analysis that way too, where I look at very big picture, and I do a very back of the envelope calculation, very rough calculation, and I get a range of intrinsic value, and I like to keep it very simple. There are some people who are much more linear in their thinking, and there's nothing wrong with that. It's just two very different ways of thinking, and ideally you can be good at both, but I don't think most people are have a proclivity one way or the other, and they think a lot more like engineers. So, very black and white linear thinking, has a harder time seeing the big picture to things, and they'll get so into details with things, and I think that's great on one hand. The problem is you run into precision issues. So even though some of these guys are so smart and they're so good at detail, and they could write an entire technical manual of some computer assembly code if they really wanted to, with business it's not going to be as precise. So if you were valuing Clorox as a company, for instance, you could probably go around to every single grocery store and Walgreens and figure out how many are on the shelf at one time, and do all these really precise calculations. And you could calculate their pension plan. I don't even know if they have a pension plan. I'm just hypothetically making this up and just using Clorox as just the first thing that came to my mind. And you could figure out their pension liabilities over time, and get into the very nitty-gritty detail of every single little expense and cost. And what you'll end up with is, sure, you'll have a very detailed spreadsheet, but half those numbers are going to be wrong, and either to the upside or the downside. And the person who's just saying slapping a multiple of free cash flow or slapping a multiple of earnings may come up with a very similar number or similar range that may be just as accurate, probably just as accurate for the loose range that you create. And you're probably spending 1/100th of the time on that investment. So there's a good rule that just because you've spent a lot of time and done all this deep analysis doesn't mean that you have some kind of better handle on the intrinsic value of the business. And I think a lot of people have a hard time psychologically with that. So Buffett says, focus on the forest, forget the trees. And he says, investors who evaluate, he's going to say this a little bit nicer than I will, but he goes, investors who evaluate Berkshire sometimes obsess on the details of our many and diverse businesses, our economic, quote, trees, so to speak. Analysis of that type can be mind-numbing, given that we own a vast array of specimens, ranging from twigs to redwoods. A few of our trees are diseased and unlikely to be around a decade from now. Many others, though, are destined to grow in size and beauty. Fortunately, it's not necessary to evaluate each tree individually. It's like, thank God you're saying that. To make a rough estimate of Berkshire's intrinsic business value. That's because our forest contains 5 groves of major importance, each of which can be appraised with reasonable accuracy in its entirety. 4 of those groves are differentiated clusters of businesses and financial assets that are easy to understand. The 5th is our huge and diverse insurance operation, which delivers great value to Berkshire in a less obvious manner, one I will explain later in this letter. So he's basically using the what he has called the two-pronged approach, and he actually uses those words later down in the letter, and he says, sometimes we can buy control of companies that meet our tests for what we look for in a business. Far more often, we find the attributes we seek in publicly traded businesses, in which we normally acquire 5 to 10% interest. Our two-pronged approach to huge-scale capital allocation is rare in corporate America, and at times gives us an important advantage. So he says, he talks a little bit about the valuations that he sees, and he says, in recent years, a sensible course for us to follow has been clear. Many stocks have offered far more for our money than we could obtain by purchasing businesses in their entirety. That disparity has led us to buy about $43 billion in marketable equities last year, while selling only $19 billion. Charlie and I believe the companies in which we invested offer excellent value, far exceeding that available in takeover transactions. So I think there's two important things to note here. Number one, in the news, there's so much news around private equity deals and private equity transactions. And I've been saying for quite some time that the investor in common stock should probably do better on average right now than if you are buying into some, venture capital private equity fund where the valuations are sky high for a lot of these businesses. And it's interesting to know, right, that Buffett and Munger are refusing to play that game if it means that they have to pay, higher valuations than they're comfortable with. So they have not bagged a proverbial elephant, if you will, for I think it's since Precision Cast Parts and 3 years ago. So they're just sitting on that cash and waiting, and they're saying, hey, as long as this market environment continues, we're going to keep buying marketable securities because we're finding better value in publicly traded companies than we are in the private market. There are people who are obsessed with private equity, and they think somehow because the company's private it adds more value, but of course that is such ludicrous thinking, and over time I've actually, there was a chart, I don't remember where I saw it, but it showed the returns for private equity over time compared to just the general stock market. And the average private equity investor, with all the work that goes into helping with these companies and doing all those stuff, actually made less money over time than if you had just bought an index fund and held it. It's kind of amazing. He also says that despite our recent additions to marketable equities, the most valuable grove in Berkshire's forest remains the many dozens of non-insurance businesses that Berkshire controls. And he said that these subsidiaries earned $16.8 billion last year. And when he says earned, he goes, we are describing what remains after all income taxes, interest payments, managerial compensation, restructuring expenses, depreciation, amortization, and home office overhead. And then he says, and he just destroys so many of these management teams, where he goes, that brand of earnings is a far cry from that frequently touted by Wall Street bankers and corporate CEOs. Too often, their presentations feature, quote, adjusted EBITDA, a measure that redefines earnings to exclude a variety of all too real costs. But this is where he gets savage. This is my favorite part in the entire letter. So I'm going to read this word for word because it's just too good. So literally, if you saw my notes right now, I'd have in all capital letters, savage with 2 exclamation points. That's how badass this is. So he goes, I'm just going to read 2 very short paragraphs, which are more like 3 or 4 sentences. And he says, for example, management sometimes assert that their company's stock-based compensation should not be counted as an expense. And then in parentheses, he goes, well, what else could it be? A gift from shareholders? And then he says, and restructuring expenses? Well, maybe last year's exact rearrangement won't occur, but restructurings of one sort or another are common in business. Berkshire has gone down that road dozens of times, and our shareholders have always borne the cost of doing so. Abraham Lincoln once posed the question, if you call a dog's tail a leg, how many legs does it have? And then answered his own query. 4, because calling a tail a leg doesn't make it one. Abe would have felt lonely on Wall Street. So, I just love that, those 2 parts. He has no qualms bashing some of the bullshit that he sees on Wall Street. I love it. And that's another thing too, where you have these, large tech companies, and they don't count, issuing options, for bonuses and management compensation as an expense. And it's like, wait, really? That's not an expense? Seems what is it? And so I've just always thought that was extremely disingenuous not to call those expenses. So then he says, he also talks about depreciation charges. And what's interesting is he says that the $8.4 billion depreciation charge, so he goes, Charlie and I do contend that our acquisition-related amortization expenses of $1.4 billion are not a true economic cost, and we add back those costs to earnings because we are evaluating both private businesses and marketable stocks. But then he says, in contrast, Berkshire's $8.4 billion in depreciation charges understate our true economic costs. And what he is saying, and the reason he's saying that essentially is, yes, we have our depreciation expenses, but the cost to remain competitive in those businesses where we, have depreciation, really we have to spend more on that to keep our competitive advantage alive. So really, the cost of doing business is higher than what he's depreciating the assets on. So he basically says this. He goes, we need to spend more than this sum annually to simply just remain competitive in many operations. So beyond these, quote, maintenance capital expenditures, we will spend large sums in pursuit of growth. So what he's saying is that the maintenance CapEx number is actually misleading, because spending money to grow some of these businesses will have the inherent advantage of increasing or simply just keeping their competitive advantage alive, which is part of the intrinsic value of that business. So if you were to cut some of that growth spending to have your, quote, maintenance CapEx to keep the business just chugging along, what you're doing by starving the business of more, essentially just letting the business run bare bones, over time that competitive advantage is going to erode and inherently erode the intrinsic value of the business as well. So I thought that was an interesting insight, and it's not something a lot of people talk about. He goes, Berkshire's runner-up growth by value is its collection of equities. And he says, we do have he goes, if the portfolio has been sold at its year-end valuation, federal income tax of about $14.7 billion would have been payable on the gain, but in all likelihood, it will hold most of these stocks for a long time. Eventually, however, gains generate taxes at whatever rate prevails at the time of sale. He also talks about this irrational love of dividends, which is something I've if you've ever talked to me privately, I've talked about it all the time. I've talked about it on Facebook. He goes, our investees paid us dividends of $3.8 billion. When he says investees, he means the equities of the publicly traded companies that he owns. So those publicly traded companies in his in the Berkshire stock portfolio paid $3.8 billion last year in dividends, and that somewhat increased in 2019. But then he stresses, and he says, far more important than the dividends, though, are the huge earnings that are annually retained by these companies. So consider as an indicator these figures that cover only our 5 largest holdings. So he says, look at American Express. We own 17.9% of the business, and if you look, it shows that Berkshire received $237 million in dividends from American Express this past year. But then with retained earnings, American Express retained $997 million in retained earnings. So he says, GAAP accounting, which dictates the earnings that we report, does not allow us to include the retained earnings of investees in our financial accounts. I think that's a really strange way to say it. So essentially, if you own they own 5.4% of Apple, and Apple paid $745 million in dividends to them, right? That goes straight on the books. But then Apple retained $2.5 billion in earnings. But that doesn't show up on Berkshire's books because they only own slightly over 5% of the company. What Buffett is saying is you need to, when you're figuring out how much these companies are paying back to you, retained earnings matter. And a lot of these companies, it matters even more than the dividends. So really that $2.5 billion you could see is if Apple's a 5.2% owned or 5.4% owned subsidiary of Berkshire, well, you own $2.5 billion of retained earnings, which would be attributable to Berkshire, but that doesn't show up on the books. But he's saying that's a way to think about it. And I actually say, if you want to look at your own stock portfolios at your own little holding company, you can actually calculate, what percentage of the company you own. It's going to, for most of you guys, it'll be like 0.0001% of something, unless you're dealing with tiny micro caps or you're a large hedge fund manager, who's a fan of the show or who hates the show, but just listening anyway. And you can then say, okay, well, what part of the retained earnings is my de facto holding company having? And you can actually calculate, what your earnings what your equivalent earnings were for the year of your mini holding company, aka your personal stock portfolio. I think it's a healthy way to look at things because it actually allows you to focus more on what the businesses are doing as opposed to what a weekly, monthly, or even a yearly stock price is going on, and changing net asset value of your own portfolio. We go to the next page now, and he says, he's talking about the different categories of value. So he says, the third category of Berkshire's business ownership is a quartet of companies in which we control, we share control with another party. Our portion of the after-tax operating earnings of these businesses, and he says, we own a part of Kraft Heinz, 50% of Berkadia and Electric Transmission Texas, a 38.6% share of Pilot Flying J, and that totaled about $1.3 billion in after-tax operating earnings. So you would slap, whatever you thought an appropriate multiple was to that. Then he says in the fourth grove, Berkshire held $112 billion in treasury bills and other cash equivalents, and then there's another $20 billion in miscellaneous fixed income instruments. So essentially you would just value that at 112, just because he has said that they always need about $20 billion in cash at all times. I think he says that actually. So when he talks about the $20 billion, he actually says, he goes, we consider a portion of that stash to be untouchable, having pledged to always hold at least $20 billion in cash equivalents to guard against external calamities. We also have promised to avoid any activities that threaten our maintaining that buffer. So you could really look at, the way that I do it, I just look at that $20 billion and say, okay, that $20 billion is there to keep that competitive advantage of Berkshire, right? You have that $20 billion, there's that level of safety and that fortress balance sheet that Berkshire provides, and also ensures that future intrinsic value creation. Just, if there's a gigantic earthquake or another Hurricane Katrina or something even worse, that, Berkshire can write business the next day, where a lot of its competitors may go belly up from something like that. So that $20 billion is part of their competitive advantage, part of what they need to increase their intrinsic value and have that Berkshire advantage. Therefore, you would not be liquidating that $20 billion. It's simply a cost to run the business. Now, this is interesting. He's subtle in some ways about this, but this is a legacy thing, and he's saying Berkshire will forever remain a financial fortress. And then later later he says, but I will never risk getting caught short of cash. And I think that's really smart, and he's signaling to future management, hey, we are forever keeping this practice. And then he talks about himself, and he says, look, in managing, I will make expensive mistakes of commission and will also miss many opportunities, some of which should have been obvious to me. At times, your stocks will tumble as investors flee from equities, but I will never risk getting caught short of cash. So he's saying, hey, in the future, you guys manage your Berkshire. Remember, forever we remain a financial fortress. We will never get caught short of cash. And that is like in the Berkshire like lifeblood of the business. And there's a religiosity about that principle. He also says, though, that, you know, the prices are, quote, sky high for businesses possessing decent long-term prospects, you know, in the private market. So he's saying, essentially, if this continues throughout 2019, that most likely you will see Berkshire expanding their holdings of marketable equities, and, you know, not buy more large private businesses. And he says, but we continue nevertheless to hope for an elephant-sized acquisition. Even at our ages of 88 and 95, I'm the young one, that prospect is what causes my heart and Charlie's to beat faster. And then in parentheses, he says, just writing about the possibility of a huge purchase has caused my pulse rate to soar. Okay, the next part. He does make a note about market timing, though, and I think this is... maybe it's partially for the shareholders, and I know he says he writes for the shareholders, but I think this might be just to calm down the news media, too, which is probably the responsible thing to do. And he says, my expectation of more stock purchases is not a market call. Because you could literally see, if he did not write that in, headlines this morning would be, you know, Buffett thinks the stock market's head for a crash, and he's holding cash to prepare for the crash. And that could cause all kinds of self-fulfilling prophecies with someone like Buffett making that claim and losing faith in the system, and however the media would report something like that. And it blows my mind. It doesn't blow my mind so much that a lot of the media and journalists outside the financial realm will write sensationalized articles, but it does blow my mind that even financial journalists sometimes write the dumbest things. And I'm just like, did you really believe that? Or, like, you're a financial journalist, you can't be that stupid when it comes to writing basic financial articles. I digress. So he says, you know, Charlie and I have no ideas how the stocks will behave next week or next year. Predictions of that sort have never been a part of our activities. Our thinking rather is focused on calculating whether a portion of an attractive business is worth more than its market price. And all he's saying is right now we can't find private businesses like that we would want to own, but you also got to remember they're a very large company. So when he's talking about big elephants, you know, big major private businesses, you can still find good deals at small, tiny little private businesses that are not going to move the needle at Berkshire. That's not what he's talking about, for full disclosure. So he's saying he just finds better value in equities for the things that for Berkshire's able to buy that can move the needle. So he says, you know, I believe Berkshire's intrinsic value can be approximated by summing up the values of our 4 asset-laden groves and then subtracting an appropriate amount of taxes eventually payable on the sale of marketable securities. He also talks a little bit about float and just, you know, how amazing the float is. And he says, beyond that, much of our ownership of the first 4 groves is financed by funds generated from Berkshire's 5th grove, a collection of exceptional insurance companies. We call those funds float, a source of financing that we expect to be cost-free or maybe even better than that over time. We will explain the characteristics of float later in the letter. And he also, this is another signaling to not so much future management, because they're going to know this, but to Wall Street and to market expectations. Because sometimes Berkshire actually will get a discount for being a conglomerate when really they should be getting a premium for being a conglomerate. Generally, you know, over the decades, conglomerates have gotten a very, very bad rap, and for good reason. But not all conglomerates are created equal, obviously. Berkshire, I mean, so he's clear, and he says, I'm actually really glad he said this, because it's you know, likely you'll get a fair price for Berkshire in the future. if you ever wanted to sell Berkshire. It kind of sucks to have to want to sell Berkshire and feel like you're not getting paid a fair price for it by the market. So he says, finally, a point of key and lasting importance. Lasting importance. He says, Berkshire's value is maximized by our having assembled the 5 groves into a single entity. This arrangement allows us to seamlessly and objectively allocate major amounts of capital, eliminate enterprise risk, fund assets at exceptionally low cost, and occasionally take advantage of tax efficiencies and minimize our overhead. And then he says in a separate line, this is how important it is, and I underline this. So he is signaling here, no breakup of Berkshire when I'm dead. That's what he's saying. And he goes, at Berkshire, the whole is greater, and then he says, considerably greater than the sum of the parts. Enough said. Next part, he talks a little bit about repurchases, and this part I think was a little strange, something he said, where he says, earlier I mentioned that Berkshire will from time to time buy its own stock. Buying back stock will benefit both those shareholders leaving the company and those who stay. Now, you remember that it was just a few years ago, before all this buyback stuff, he talked, it might have been maybe 5 or 6 years ago now, but, not that long ago, Buffett had said, he really doesn't like to buy back stock below intrinsic value because he feels like he's buying out his partners at a bad price. And it's like, dude, come on. It's like they have the same information as everyone else. Some people are day traders and not long-term holders of Berkshire, number one. Number two, they have the same info as everyone else, so it's not like there's some unfair advantage where you're exploiting people. And then the third thing is that if you're a Berkshire shareholder and Buffett is buying out the other partners below intrinsic value, well, they chose to sell to Buffett and you stayed on, and now you have, again, a higher ownership of your shares, and the intrinsic value of the business has, at least hopefully, increased. Who's going to be complaining about that because you bought back from a shareholder you've never met, and they sold at a price below intrinsic value? I always thought that was a little bit of a stretch, and now he's kind of reversing course and saying, well, this benefits both the buyer and the seller. And then he goes, true, the upside from repurchases is very slight for those who are leaving. Well, yeah. But then he's like, well, that's because careful buying by us will minimize any impact on Berkshire's stock price. Okay. And then he says, and I thought this is kind of a justification. And he says, well, nevertheless, there's some benefit to sellers in having an extra buyer in the market. Oh, please, come on. If let's, I don't know, Johnson & Johnson stock, General Motors stock, pick any large company in the United States. If the company is buying back their own stock kind of consistently in a way that's not moving the stock too crazy, I don't really think it's benefiting those people. There's enough liquidity in most of these shares. Sure, if you own hundreds of millions of dollars of Berkshire Class A and you need to get out of it within a few hours or a few days, yeah, okay, I could see that. But I think for the vast majority of people, there's no benefit to Berkshire buying back their own stock to those people who want to sell Berkshire. Just saying. What else is, he does say that some sellers may disagree with our calculation of value, and others may have found investments they consider more attractive than Berkshire shares. And he goes, some of that second group will be right. There are unquestionably many stocks that will deliver far greater gains than ours, and that's just because Berkshire has gotten to a size where there's only so much they can move the needle every year. He talks about company-wide budgets. So he says, furthermore, Berkshire has no company-wide budget. Our lack of such an instrument means that the parent company has never had a quarterly number to hit. Shunning use of this bogey sends an important message to our many managers, reinforcing the culture we prize. And this just lets managers focus on actually growing the businesses and being intelligent about it, as opposed to having to hit some, arbitrary quarterly number that they may or may not, and then feel pressure and start undermining their own business in order to make the numbers, which could be a terrible, terrible thing to really screw up a culture, and it could lead to pressures of unethical business behavior. All right, let's move through this a little bit more. He just talks about then he goes, the most valuable part of Berkshire is going to be our collection of non-insurance businesses. And it's just the numbers. This is what's unbelievable about the Berkshire engine. So he says, viewed as a group, these businesses earned pre-tax income of 2018 of $20.8 billion, which is a 24% increase over 2017. So that's, again, why he loves owning these private businesses we can get a good price, is he's been able to still significantly increase their pre-tax earnings even at these kinds of large levels. So that's a real value engine. And, you slap on, $28 billion of value in earnings, that's going to be significantly, worth. And this is where the idea of book value stops being so relevant, because I don't have the numbers right in front of me, but there's going to be the book value of those non-insurance businesses, right? But then there's the $28 billion of, pre-tax earnings. So say those $28 billion, what's the intrinsic value of that? Probably somewhere, maybe about $250 billion if you slap on like a 12x pre-tax multiple. That's real value, and if that's growing at 24% a year, holy crap! That's a real driver of intrinsic value, and you're just not going to get that with marketable securities. The other advantage, which he kind of says, is where he says before with the equity portfolio, you're going to have to subtract some of those taxes that'll eventually get paid out when he makes sales, because they do sell stocks at, even though he says he's a long-term investor, they're still buying and selling stocks, so there's still some capital gains pretty much every year. I think probably every year, where they're paying taxes on it. So that number does mean something. That tax liability is a real liability. It's not like float, which actually ends up becoming more of an asset than anything. Where he even says that float is more valuable than if it was equity, just because you're getting paid to own the float at Berkshire. Where they've been profitable 15 out of 16 years in their insurance operations, and those insurance operations made $2 billion in pre-tax and $1.6 billion in after-tax. I mean, unbelievable. Anyway, I'm getting side note, but So with this though, yes, it's technically you could calculate how much it would cost to sell a private business, and the taxes you have to pay on that. But he Buffett says, don't even worry about that. Don't put that in the calculation, because we're not going to sell. So as long as he's holding these businesses indefinitely, there's going to be no taxes on a sale of the company of a private businesses. And those earnings are growing by a lot. And then you can slap say a 12x multiple, I don't know, something around there, 10, 11, 12, 13x, whatever multiple you want to put on there, and you can play around with a few different assumptions. That's going to be worth more. No taxes in the calculation, and a multiple of earnings that are growing very, very fast, and faster than most of these public companies that you can buy a stake in today at a good value. So that's the other thing. The other thing too is that when he can buy a private business, often it's family owned or run by a very passionate CEO, and they'll sell to Buffett at a price that's lower than if they sold to a private equity fund, because they want to be part of the Berkshire system. So buying these private businesses or having full control of these businesses at Berkshire just makes so much more sense. And I just really want to stress that point, because Berkshire should. The more Berkshire buys private businesses and not equities, the more shareholders should actually be celebrating. Yet people get so obsessed with what is Berkshire buying and selling today in the stock market, but the big driver of value is going to be the private stuff. And when he's not buying that, that's a real cost long term if you can't find something to buy. He also talks about the corporate taxes And he has said that they have materially increased the intrinsic value of Berkshire shareholders. And he uses an analogy. So he says, let's begin with an economic reality. Like it or not, the U.S. government owns an interest in Berkshire's earnings of a size determined by Congress. In effect, our country's Treasury Department holds a special class of our stock, call this holding the AA shares, that receive large, quote, dividends, that is, tax payments, from Berkshire. In 2017, as in many years before, the corporate tax rate was 35%, which meant that the Treasury was doing very well with its AA Berkshire shares. Indeed, the Treasury's, quote, stock, which was paying nothing when we took over in 1965, had evolved into a holding that delivered billions of dollars annually to the federal government. Last year, however, and this is where he starts talking about corporate taxes, 40% of the government's, quote, ownership, 14/35, was returned to Berkshire free of charge when the corporate tax rate was reduced to 21%. Consequently, our A and B shareholders received a major boost in their earnings attributable to their shares. This happening materially increased the intrinsic value of the Berkshire shares that you and I own. The same dynamic, moreover, enhanced the intrinsic value of almost all of the stocks Berkshire holds. So it ends up becoming a double whammy. And at the end of that paragraph, I'm not going to read the whole thing, but he says, so overall, however, the new law made our businesses and the stocks we own, and then in italics, he says, considerably more valuable. So he really wants shareholders to take note that was a real impact to intrinsic value from that one little change in the tax law. So then he says, which suggests that we return to the performance of our non-insurance businesses. Our two towering redwoods in this grove are BNSF, which is the railroad, and Berkshire Hathaway Energy. Combined, they earned $9.3 billion before taxes last year, up 6% from 2017. And then he just goes through all the different businesses and how much they earned pre-tax. And then he said the remaining non-insurance businesses that Berkshire owns, and there are many, had pre-tax. Okay, I'm not going to go into that. He basically just going through all the major businesses and small businesses, and he added it all up, which I talked about earlier. Then he talks about float, and he says, this is our fifth grove, as our property casualty insurance business. And this has been the, quote, engine propelling Berkshire since 1967. And that's the year, for those that you don't know, where Berkshire acquired National Indemnity. And then the sister company, National Fire and Marine, for $8.6 million. And now National Indemnity is the largest property and casualty company in the world, as measured by net worth. Whew, I've been up a long time. One reason... So he says, one of the reasons we were attracted to the P&C business was the business model, where the insurers receive premiums up front and pay claims later. So this is what's called float. It goes this collect now, pay later mode model leaves companies holding large sums of money that we call float. And this is amazing. So float in 1970 was $39 million. Today it's $122.7 billion. Even in 2010, just if you look at the numbers from 2010 to 2018, that number has gone from $65.8 billion to $122.7 billion. If you go back from 2000, float has increased from $27.8 billion to $122.7 billion. That's just unbelievable. And, he says the way that their float is structured is that there will never be no more... So he says, we may in times experience a decline in float, but the decline will be very gradual. In the way that they've structured their insurance business, it never allows for more than a 3% decline in any given year. And this is basically so that there isn't some, large payout in 1 year, and they start having to be forced to, sell a private business, God forbid, or sell a large portion of their equity portfolio and pay huge cap gains taxes. So he says at the end of that, the strength will never be compromised. And then he also talks about float, and he says that because their insurance business has made money almost every year for the past 16 years, except for 1 year, he's getting paid to own
he's basically getting paid to have float. So he says, when such a profit is earned, we enjoy the use of free money, and better yet, we get paid for holding it. And that money we get paid is called float. And then he says the big strength of Berkshire is that, they pounded into their insurance underwriters to write, good policies, and they all understand the concept of float. And he said that most insurance businesses, they pay lip service to that, but where Berkshire, it's a religion. And it's clearly true, because, most of that industry will actually make an underwriting loss, and they actually have to pay to have that free money. So Buffett says he sees that trend continuing, and that the insurance business will continue to earn terrible returns on their tangible capital and operate. A lot of them will operate at losses for years to come. So he says, so they've been profitable 15 out of 16 years, which is just unbelievable in the P&C industry. He said that kind of strength and stability gives them a huge competitive advantage, especially if there's a major disaster. They'll be able to just keep taking market share regardless. And let's see what else he says. He also talks about the use of debt at Berkshire, and he says, we use debt sparingly. Many managers, it should be noted, will disagree with this policy, arguing that significant debt juices the returns for equity investors. And then he says, and these most venturesome CEOs will be right most of the time. And he says, at rare and unpredictable intervals, however, credit vanishes and debt becomes financially fatal. A Russian roulette equation, usually win, occasionally die, may make financial sense for someone who gets a piece of a company's upside but does not share in its downside. That strategy would be madness for Berkshire. Rational people don't risk what they have and need for what they don't have and don't need. What else does he talk about? He also talks about the importance of retained earnings, and he says, they have $349 billion of equity capital, which is just unmatched in corporate America. But he says if we had paid out our money in dividends over the years, our equity capital, instead of $349 billion, would only be worth $22 million today, the same as when we began in 1965. He also reinstates to look at float not as a liability, but to use it as an equivalent amount, but to see it as equity. And he says, beyond using debt and equity, Berkshire has benefited in a major way from two less common sources of corporate funding. The larger is the float that I've described. So far, those funds, though they are recorded on the balance sheet as a liability, they've been of more utility to us than an equivalent amount of equity. Now, the reason for that is if you have the equivalent amount of equity, it's worth whatever the equity is. But in an insurance business, if it's consistently profitable, you're now getting paid to have that float. So he says, we have been paid in most years for holding and using other people's money. So therefore, you need to count the float as a real asset. And on top of that, the other part of the insurance business is that it's making money, and you can put on some multiple to that. So it really, really makes that business very, very valuable. The fact that you're growing both, you're profitable. So you have a profitable line of insurance business already, and then you have this amazing asset called float, which again looks like a liability. Then the final funding source, which he also said really needs to be looked at as part of the equation, is deferred income taxes. And he says they possess these to an unusual degree. And he says we in effect have an interest-free rate loan that allows us to have more money working for us in equities than otherwise would be the case. So he says we also have a $28.3 billion of deferred tax results from our being able to accelerate the depreciation of assets, such as plant and equipment, and calculating the tax we must currently pay. This front-end saving and taxes that we record gradually reverse in future years. We regularly purchase additional assets, however. As long as the present tax law prevails, this source of funding should trend upwards. So then he basically says, those are the components you need to value the business. He talks a little bit about Geico and Tony Nicely, and it's an amazing acknowledgement towards him and the amount of value that he's created at Geico. I'm not going to read you that entire thing. He mentions the equity portfolio, talks about how amazing the businesses are in the equity portfolio, and he says on a weighted basis, these companies are earning about 20% on net tangible equity capital required to run the businesses. And they also earn profits without employing excessive levels of debt. And then he says, you need to compare this, let's compare this to, he goes, these are mind-blowing numbers regardless, but he goes, they're, quote, truly mind-blowing when compared against the return that many investors have accepted on bonds over the last decade. 3% or less on 30-year U.S. Treasury bonds, for example. So I thought that was important to mention as well. And I will also say this, is that if you look at some of these value investors who the last few years have underperformed the market, the underlying business fundamentals, however, have been unbelievable, and the stock price hasn't always moved in relation to how wonderful these businesses are. And those are trends that go back and forth, but people who generally have a value approach to investing, which really to me is all investing, it's been tough for a lot of these guys, and a lot of funds have closed down. And I think, as just a side note, and I'm biased obviously in saying this, obviously because I run my own company, but if I didn't run my own company, I would be looking at talented value managers and say, okay, what are the businesses they've actually invested in and over the last 5 years? Have they avoided some major mistakes, of major permanent losses of capital, and have their theses and fundamentals generally worked out, and whatever the market's just gone ahead of them just because of the multiple expansions, which most investors aren't going to be buying something that they think is fairly valued just to have the multiple expanded. If you're going to buy a company, I'm going to buy something at 25 times earnings hoping it goes to 30 times earnings, yet the earnings aren't going to grow that much. Most people, that's probably not a wise way to invest in the long term. But if you've done that over the last 5-7 years, a lot of the people like that have been really rewarded. So I think you're going to need another market downturn, kind of another economic cycle, if you will, to really see who's swimming naked and who really has good skill sets. And and I think it's frustrating for people, just because this cycle has gone on longer than most, and maybe part of that was because we had such a we came off of such a horrible period in 2008 that it might have exaggerated this bull market a little bit more. Another reason for that too is if you look at the data on returns on capital, right? There's so many more companies now that need less and less capital to operate, right? So you could actually say that book value per share is significantly less important than it was 30 years ago, certainly more than 50 years ago, right? Where if you look at the major components of the Dow, in the early 1900s, almost all of them you would have valued on a book value basis. Where now, if you look at the top companies in America, a lot of them you would never value on a book value basis, like Facebook or Amazon or something like that. And he talks about the American tailwind. We're almost done, and he says, if you had invested. He's like, my first investment, I put $114.75 in my first investment 77 years ago. And he says, if I had put my money into an S&P 500 index fund with no fee, had all my dividends reinvested, my $114.75 would now be worth pre-tax $606,811, which is a gain of 5,288 to 1. And he said, if you had $1 million investment in a tax-free institution like an endowment or something, that $1 million investment would now be worth $5.3 billion. What's also interesting is he talks about, he says, those who regularly preach doom because of government budget deficits, as I regularly did myself for many years, might note that our country's national debt has increased roughly 400-fold during my lifetime. That's a 40,000% increase in the national debt. So he goes, suppose you had foreseen this increase and you panicked at the prospect of runaway deficits and a worthless currency. So he's talking about, runaway inflation. He said, so to quote, protect yourself, you might have went for stocks. You might have not gone for stocks and instead opted to buy 3 1/4 ounces of gold with your $114.75. And what would that supposed protection have delivered? You would now have an asset worth $4,200, less than 1% of what you would have had realized from a single unmanaged investment in American business. The magical metal was no match for the American metal. And he says, our country's unbelievable prosperity has been gained in a bipartisan manner. 7 Democrats, 7 Republicans, and in the years they served, the country contended at various times with long periods of viral inflation, a 21% prime rate, several controversial and costly wars, the resignation of a president, a pervasive collapse in home values, a paralyzing financial panic, and a host of other problems. All engendered scary headlines, and all are now history. So he said that if you look at the wealth of America, what really fuels that is savings. And I think this really speaks to how idiotic some of these politicians are, and also just, some of these people are who are kind of bashing rich people because, all their money is in a bank account. They're not doing anything with their money. We need to tax them more. And they don't get it, right? So Buffett bashes that kind of thinking. And he says, remember earlier in this letter how I described that retained earnings as having been the key to Berkshire's prosperity? Well, it's also been the key to America's prosperity. In the nation's accounting, the comparable item is labeled, quote, savings. And save we have. If our forefathers had instead consumed all they produced, there would be no investment, no productivity gains, and no leap in living standards. And you got to remember that the growth in America has come from investment in productivity gains, which inherently creates those higher living standards. And it just always blows my mind when people still want to focus on, well, those people are poor, those people, are can't afford blah, 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 blah. And first not realizing that if you look at the poor in the United States compared to what the poor in the United States looked like 250 years ago, it's a very different kind of standard of living. Also, even if you look at the standard of living of someone like J.P. Morgan in the early 1900s, if you are a middle-class American today, you have a better quality of life than J.P. Morgan did, who was the richest man in the country at that time in the early 1900s. And Buffett likes to point that out. And there's a psychological principle behind this. And they've done studies where they say, would you rather be super, super wealthy in the early 1900s but have a poorer, have poorer living conditions, right? Like no refrigerator, no heat. You have to, make your own fires and less sanitation, lower lifespan expectancy, all of these things, right? I mean, there was way more misery in the world back then, but people don't want to remember that or don't focus on that, right? And they say, would you rather be very wealthy back then or live better but be middle class in today's society? And most people will actually say they'd rather live back then and be much wealthier. And it's amazing how people think, and actually sometimes will even feel happier when they can compare what their lives look like to someone else's. And if you look at, say, this trend of depression caused by Facebook and social media, which has become a real thing, where people now have these unrealistic standards of what their lives should look like, because people post on Facebook all their best moments, sort of stage pictures. So it looks like everyone now is living this unbelievable life. And if you can't compete with them, well, am I doing something wrong? Is there something wrong with me? And people start comparing. And it's, people were honest about their day-to-day conditions on Facebook and said, oh, today my life sucked. Today this happened to me. Today I felt really, really shitty. Today and this. And if people talked about all the all the negative and terrible things that happen in life as openly as they did the positive things, people would have maybe realized they don't have it as bad as they don't have it worse than everyone else, and that everyone's going through their own stuff. So I just always thought that was interesting, and there's a lot of psychology behind why people want to bash the rich, or they want to somehow be better off in an earlier time period. I'm digressing a little bit, but I wanted to say that. So people who are wealthy, who are saving a lot of money, really are contributing a lot to society in terms of increasing the standard of living, and that's just how it is. It's not just an opinion. And I really don't like when those things get politicized, because it does a disservice to our national conversation, and it prevents people from having rational dialogue as well. For someone not to realize that savings add value to the economy, there's a ton of brainwashing behind that, and just if you show people facts and they still don't want to change their mind, that says everything you need to know. So he says, there are many countries around the world that also have bright futures, but we should rejoice that America will both be more prosperous and safer if all nations thrive. And I think he's sending a message to our leaders that, hey, if other companies are doing well, other countries are doing well, it's not at the expense of America that actually helps America. And again, throughout history, you've seen that, when we have trading partners that are healthy, people who trade with each other are less likely to go to war with each other. War tends to not have any good economic consequences, and you're destroying your workforce. You're killing off your workforce and putting a lot of your country into debt because of it, and then you can have an inflationary scenario. So that was generally the annual report this year. The one other thing I would say is, if you look at the supplemental information, they didn't buy back a lot of stock. That was, I actually thought this year's letter was kind of like there wasn't that much that was really new. But the one thing, though, that I think surprised me, and I would imagine probably surprised a lot of people, is that he wasn't buying back a lot of stock during this past quarter when the market went down a lot. I actually, if I had to guess and make a bet, I would have been wrong. I would have said, the reason that Berkshire didn't buy a lot of equities this past quarter during the downturn was that he was buying back his own stock, and it turned out that wasn't the case either. So he still has a lot of cash, and he's signaling that if things stay the way they are, and that to expect another year of not many, if any, large acquisitions, and that they might just buy back stock opportunistically. But I question that and wonder when that will happen, if it will at some point. But also, just he seems like he's just gonna keep opportunistically buying equities and buying back his own stock, and we'll see what happens. So anyway, that is the general gist of the letter. It's worth a read, but I don't think it's one of his best. Maybe there wasn't just much to talk about this year. Anyway, I hope you have a wonderful rest of your weekend, and if you have any feedback, you can email me at intelligentinvesting@gmail.com or shoot me a message on LinkedIn. Thanks for listening, guys. Have a great weekend. See you on the next episode.
Thank you for listening to the Intelligent Investing Podcast with Eric Schleien. If you'd like to connect with Eric for questions, comments, feedback, ideas, or to inquire about being on the show, please contact Eric at intelligentinvesting@gmail.com. So, in the words of Charlie Munger, I have nothing to add.